a bit worried about the data in the near term, but if we get through the next couple of months, I'm really kind of positive on the sort of medium to 1 year outlook. I think if in fact we get a continued expansion and we have rate cuts, then this kind of reminds me of 2019, where you had expansion and rate cuts, and markets went on to have, a 20% year. I think we're a higher valuation level now, so maybe that's asking too much, but still, it's a healthy backdrop to get growth and rate cuts at the same time. I would say that when it comes to rate cuts, I do think the market's getting ahead of itself also there. I see, I think I'm looking at market pricing that throughout the rest of this year and into 2025, the market, I believe, is pricing something like 9 to 10 rate cuts. Our assumption has more been like 4 to 6. But still, I think this adds up to a good backdrop. If we can get growth and rate cuts at the same time, that should be a pretty good backdrop for investing.
Well, we just know how bad the market has been at predicting how many rate cuts there are going to be. I mean, what were we expecting at the beginning of this year, and how many have we seen them pull back on? But anyway, that aside, you made another interesting comment earlier where you were saying, look, if there's going to be a bad jobs number now, the market will be very sensitive to that. So are you suggesting that we're no longer in that sort of paradigm where bad data is good for the market, because it means that, the Fed might be able to have a little bit more leeway with rates? Are we now in a scenario where bad data is going to be bad for the markets as well?
Yeah, I think that's right, and I don't think the market's appreciating that right yet. I actually, as I talk to other fund managers, I kind of sense they're thinking that a bad job number will confirm a 50 basis point rate cut, and that'll be great. But I think what we're seeing right now is what the equity market is pricing in terms of growth is different than the bond market. In order to get, these 10 rate cuts that the bond markets are pricing, it really is assuming a very weak growth scenario. That's assuming a jobs problem that the Fed's going to have to react more strongly to. And that scenario isn't good for equities. It isn't good for earnings growth. So I think we're in a sort of delicate balancing point here. Too strong jobs obviously means the rate cut story gets hurt, but too weak, and I think markets will question exactly how strong this recovery is. And I guess we've just been pointing out that there's been a number of weak data points. The manufacturing PMIs are weak. Consumer confidence is very weak. Retail sales has been sort of just patchy, and we've sort of been counting on jobs as being the main engine of growth. And if we lose that, then I think economists are start to actually sort of change the way they're articulating what they're seeing.